Hello, and welcome to this webinar hosted by the Gulf International Forum titled War, the Economic Forecast and Future of Gulf Diversification Plans. I'm Rachel Ziemba, and I'm a non-resident fellow here at the Forum. This is one of many webinars the Forum is putting on in both English and Arabic. So we're glad that you've joined us. Please check out the others and watch for further programming. Today, we're over 80 days into this conflict, almost 3 months. And our focus today is about the economic and energy impacts of the conflict, but particularly on regional economies, the Gulf states. Though I'm sure we'll be talking about the global economy and how the relationship of the Gulf states with others in the region, but also other key geographies. Will be this conflict has prompted significant outages of energy supplies, particularly of oil products, of natural gas, of fertilizer. We can go into more detail, and the rerouting of a lot of key supply chains. So far as we speak, there have been a lot of global buffers drawn down, including here in the United States, which has turned the U.S. briefly into the largest oil exporter. But these buffers are finite. So we're going to be talking about the downstream effects of these blockages and what that means for very ambitious, robust economic diversification plans in the region. And this is where I think our panel today is going to be able to dive into both the regional trends, but also the country-specific ones. But enough from me. I want to introduce you to our panel and get into questions. So I'm going to introduce all of them right away, and then I'll turn to each of them in turn. First, we have Dr. Karen Young, who's Senior Research Scholar at the Center on Global Energy Policy at Columbia, also the founding director of the Program on Economics and Energy and Senior Fellow at the Middle East Institute. I was honored to serve on her advisory board at MEI, really a great group of people. Karen, glad to have you. Second, Dr. Kristian Ulrichsen, who's Baker Institute Fellow for the Middle East, also a senior non-resident fellow here at the Gulf International Forum. Kristian, thank you for joining us. And third, Dr. Gawdat Bahgat, who's also senior non-resident fellow at the Gulf International Forum, previously a professor in the Near East and South Asia Center for Strategic Studies at the National Defense University. So glad you could join us. Now, I want to dive into questions, turning first to you, Karen. Now, we've had almost 1 billion barrels of oil that have failed to reach their destinations. I'm taking that number from Sultan Al Jaber, the head of ADNOC. And it's one of those numbers I feel like we all have to adjust every time we're writing a note. But, it's a really big number. So we've been seeing inventories drawn down, as I was just mentioning. They've definitely not been replenished. We're seeing swaps going on. There is price pressure, though maybe not as much as some people might have expected. At what point does demand destruction kick in? Do you think we're seeing that now? And what does this look like for Gulf economies? How are you
Well,
seeing these dynamics?
thank you, Rachel, and it's great to be with you all. Yeah, we are constantly adjusting that number because the disruption to the market has not changed. We are not seeing any significant increase in flows through the Strait of Hormuz. We are lucky to have the diversions through the pipelines in the UAE and Saudi Arabia, but largely there are about almost 13 million barrels a day that is sort of absent from markets. And so the way that we've been dealing with that is drawing down inventories. And so we came into this crisis in the beginning of the year with about 8.5 billion barrels around the world, as much as we can tell, and not all inventories, whether they're government owned strategic reserves or commercial inventories, are visible. But that's essentially the estimate. And yes, we not only are sort of absent production and supply to market, but we've been drawing down from those inventories. And the real question is, where do we get to an inflection point or a point at which the reserves themselves become less stable because we continue to draw from them. And some analysts think that that is soon, like within the next month, the end of June. And so, as we continue to see really this lack of volume, that's the problem. Now, on demand destruction, that's a little different, and this is where the market perhaps is working in that there are choices. We have crude that's not getting out, but more importantly, the refined products. So diesel, jet fuel, LPG are things that are really missing. And so refiners have a choice, and the way that it is profitable either to produce gasoline or diesel or jet fuel, many of them are choosing to produce jet fuel because the margins are higher. And so that creates sort of a further dislocation or absence of some of the fuels that we need. A very good analyst at JP Morgan wrote that people don't buy crude in barrels, they buy refined product, right? So what the customer is looking for is what we're seeing sort of absent. And it takes some time. There's we as humans, our behavior changes very slowly in terms of our consumption, our driving patterns, our consumption of planning that summer vacation, how we think about our jet fuel use, and the plans we're going to make, the price point at which we say, hey, that's just too much, I'm going to cancel the plans. And so, it's been gradually building. So the demand destruction that we know is now occurring was about 2.8 million barrels a day in March. These are estimates from JP Morgan. 4.3 million barrels a day in April and 5.6 million barrels a day in May. So those are gradually increasing, meaning that as those prices get more sensitive, or we're more sensitive to them, the less that we see consumption happening. And the mix is also really interesting. You mentioned this, Rachel. Everyone's like, why aren't oil prices higher? This is this largest supply disruption to crude markets in history. Why is oil still, not 150 or $200 a barrel, but still in the 110 dollar range? And this again has to do with that difference between crude versus refined products. So the spike in crude prices has been about 40% compared to the beginning of the year, but in refined products and in different geographies really varied. The price spike is much higher. So we're seeing price spikes in refined products, jet fuel, diesel, gasoline, much higher in Asia in the range of 60 to 120% increases. So one thing that this crisis has certainly shown is that the geographic impact is really varied. Poorer countries in Asia feeling more of the pinch. Those countries that did not have very large strategic reserves. Japan, for example, has 244 days of crude reserves. A country like Thailand does not. A country like Bangladesh or Myanmar has been really the most affected with basically no reserves in place to help cushion them. So that's where you see the price spikes being most severe. The other thing that happens that sort of distorts our price sensitivity is government intervention. And we've seen a lot of this, even in the United States. Proposals to make gas holidays, proposals to continue subsidizing the prices of fuels. We've seen this in India also in terms of the subsidies of fertilizers, which has been very disruptive to the way that other countries think about their fertilizer use. So, more and more, this is a sort of beggar thy neighbor approach, every country looking out for itself, refusing to export refined product. We've got restrictions from China on refined product exports. That just makes the neighborhood all the more vulnerable. So anyway, that's a little bit of an overview of why prices are the way they are, and I think why we might see certainly in the next month some increasing pressure because of those inventory drawdowns and the sort of dislocation of where refining is happening. Who's willing to pay higher prices for
Mhm.
jet fuel? Europe is, Asia's not, right? So you're going to see real differences in availability there.
That's a great point, Karen. I think this regional diversity, but also product diversity. One of the reasons we've seen a shift is that the message to refineries, right, has been people will pay a lot for jet fuel. Let's produce as much jet fuel as we can, and maybe as much diesel, which then has impacts downstream on petrochemicals, right? And I think some people have talked about how do we unpack demand deferral versus demand destruction,
Yeah.
and how much does just the choice not to fill reserves from countries like China sort of come into the play. So I think we'll definitely come back to this. Thank you for setting that out. Turning now to you, Kristian. I wanted to turn to the GCC states. We've seen attacks on all 6 GCC states from Iran with aviation, data centers, tourist destinations, sports taking direct hits. What is your assessment now about how much this war has challenged the sort of oil diversification model? What differences do you see across the region? How are you thinking about this?
Well, thank you. And I mean, to pick up on the point that both you and Karen have made, about the diversity and the variation of impact, we see that within the Gulf in terms of economic impact as well. We've obviously had impacts across all 6 states in terms of the missile and drone attacks from Iran, from Iraq, from other spoiler actors as well. But in terms of hitting the post-oil diversification models, we had seen also just the impact on the smaller Gulf states, which Dubai and Abu Dhabi, Doha, have really pioneered the move into creating hubs for aviation, for tourism, especially in Dubai's case, for the sports as well. But again, uneven. So in terms of sport, we've had the cancellation of the Formula One Grand Prix in Bahrain and Saudi Arabia. But Saudi Arabia, by virtue of its geographical size, has a degree of depth that the other Gulf states don't. And we just saw at the end of April how the Saudis were able to hold the final stages of the AFC Champions League in Jeddah without any problems. And in the final, we had 60,000 people in the stadium, which I think would be unlikely to see that happening at the moment in some of the smaller Gulf states on the Gulf itself. So you can see a variation of impact there. Dubai has been pioneering this model for 30 years now. Doha, in terms of sport, for more than 20. Abu Dhabi has been moving into this space very heavily over the last 20 years. And the Saudis, obviously, with the giga projects, which are already in the process of being scaled back and reassessed prior to the February 28th, have been moving into this as well. Now, we have a little bit of a buffer at the moment, just because fewer events take place over the summer. But if we get towards October, November, and the beginning of the sort of more traditional heavy winter season of events, big events taking place in the Gulf, that's when I think there's some of the real economic, begin to think about longer term, even medium term consequences for some of these models if there's still so much uncertainty. I think we're all beginning to realize that even if we have moments of comparative calm and weeks without an incident happening, in this situation we're in right now, where there's no war but no peace, no agreement, of course, no unblocking of the Strait of Hormuz either. All it takes is one missile or one drone to sort of wreak havoc and get people to reassess the risks of having something in the region. We saw that on May the 4th, when we had the Iranian missile and drone attacks on the UAE just 2 days after the UAE had lifted restrictions on airspace that had been in position since the end of February. So that will really potentially do more damage if we have so much uncertainty in terms of planning. Qatar will host, or is set to host, the FIFA Under-17 World Cup in November, December. Longer term, again in Qatar, we have the 2027 Basketball World Championships for men taking place in August, September. Obviously, I think organizers will be looking at how the situation unfolds over the next few months to see what will happen with those events. Now, in terms of tourism, again, we've seen reports that there were fewer tourists, which is probably not coincidental. That, again, is going to be uneven in terms of impact. Dubai, to Doha, with visitors coming in for big events, will be most heavily affected. But again, if we see that aviation and tourism and sport were perhaps the sort of 1.0 phase of diversification, as you mentioned, data centers, that's the more recent focus of beginning to think about Gulf states diversification, especially in the UAE, Saudi Arabia. They put heavy investment into AI and into data centers. And of course, those investments take a long time. They're extremely expensive, putting the physical infrastructure into place. And at this moment of such uncertainty and unpredictability, some of those plans will be potentially being reassessed for their security risks. And so we see a kind of varied impact, but the longer this uncertainty, will we have a renewal of attacks? And of course, President Trump seems to veer between saying negotiations are ongoing or we're going to attack tomorrow, and then he pulls back. That just doesn't really bode well for the long-term stability, predictability, and certainty that investors will want. So that will be the impact for at least months to come.
To your point, and I think we'll get into more, where things are really on the investment side, because clearly some things are still ongoing, but also what questions, and to your point, Kristian, investors might not want it, but I think tourists especially, and those who are thinking about, are they relocating, and as you suggest, that might drive differentiation. And to just pull in Karen's point, we're at a point now where people might be making decisions about their fall events and fall schedules. So the lag times here will, as you say, be really interesting to watch, and the like. Now, turning to you, Gawdat, you and I were on a webinar probably about 6 weeks ago. We were talking about maritime order. Feels less and than that. Even at the time, I think we commented on how oil markets have been pricing some of these dynamics as a temporary event, maybe a longer temporary event right now. Even as ceasefires have come and gone, we're in this, what Kristian characterized as no war and no peace, this limbo. What point do you think this becomes a structural disruption that can no longer be traded through? And what does that look like? How are you seeing the scenarios ahead?
Thank you, and great to be with all of you. For many years, people have been talking about the new Middle East. I remember probably when the Iranian Revolution, 1979, people talked about the new Middle East, Oslo Agreement, and Arab Spring. But the old Middle East has survived and still there. But I believe this time there is really a new Middle East. This war has short and long-term impact, and probably the entire Middle East and probably the entire world will look different from what it was before the war. Something strikes me that the war was not surprise. In the negotiation between the United States and Iran, US bombed Iran during the negotiation, or when the negotiation was scheduled, day or two later, and Iran threatened that it will close Strait of Hormuz, that it will attack its Arab neighbors. So to some extent, I believe the war was not surprise. When this comes to oil, oil-producing countries in the Gulf were prepared for this. Many of them put their tankers outside the Gulf storage areas, so they were prepared for the war. The same thing about oil-consuming or importing countries. China was very well prepared with huge stock of oil, and this made the crisis manageable for some countries like China. The impact of the crisis varies, as Kristian mentioned, from one fuel to another, from one country to another. Here in the United States, because the United States is a major oil-producing country and large LNG exporter, domestically, American people, American consumers are paying high price, but American oil companies are making huge profits. The United States, as member in global economy, is impacted. inflation. Other countries are paying higher price. I follow Egypt closely. Now they have working days. People work online instead of going to the office. Karen mentioned different Asian countries. So the impact will vary from one country, one region to another. Another important point is when Strait of Hormuz will be open, things will not go back to normal overnight. Will take some time. And also, I believe it is not accurate to talk about Strait of Hormuz as open or closed. My prediction, after the war stops, there are many other scenarios between open and close. Most likely there will be some restrictions, maybe some fees, maybe episodes of opening and closing. But my sense is that things will not go back to pre-war. We'll see. But again, oil market, global economy will be very different after the war than they were before the war.
Thank you. And I'm glad that you brought up this question about these shifts. As you say, the maritime order, the sort of the dynamics, the importance of these alternate supply chains, whether it's for energy, whether it's for other products, these kind of dynamics definitely at play. Now, before I ask my next questions, and I could continue to ask questions to this great group of panelists for a long time, but you all are here. Those of you who are listening live have the opportunity to ask your own questions. So please take the opportunity to do so. I will try to filter them in. And after I ask a couple more questions, we'll definitely turn to you. So just a nudge to those of you in the audience, please ask questions. We want to hear from you. We want to make sure we're answering your questions. So yeah, so keep them coming, and I may group them. Otherwise, you'll just have to listen to what I want to hear about. But turning back to you, Karen. Now, I think we've all talked about how this is the sort of largest oil shock in history. We can debate about wartime, but definitely outside of that. How, I was just alluding to the fact that there's investment in new infrastructure and other things like that. What evidence are you seeing that either Gulf states or other investors are moving capital towards energy security, to diversification, to different supply chains? Are you seeing a sense that people are waiting and seeing, or some mixture? Are there other shifts that you're picking up? I recognize we're only 3 months in, so it may be early days, but what are you seeing? How are you expecting things to evolve? And are there country differences, as we're always finding when thinking about the region?
Yeah, thank you, Rachel. Great question. Well, our analysis keeps changing. The kind of growth scenarios that we see published by different analysts. The World Bank put out its sort of outlook for the region in April, and we continue to see downgrades. So what would have been, what the expectation was before the war of GDP growth for the region was like 4.5%. Then they downgraded to less than 2%, about 1.3. If you look at bank analysis now, basically all 6 of the GCC states are in sort of negative GDP growth territory, with the most severe contraction in Kuwait and Qatar, around 11% each of those. That's a JP Morgan estimate, but you'll see similar ones from other banks. What that does in terms of the investment environment is that as long as we have this, disruption and the threat of violence, and I agree with Gawdat there, like we don't return to normal magically in any of these scenarios. That the growth outlook is more dim, and this puts more onus on governments for spending to sort of prop up whatever activity that they need, including thinking about security and the hardening, particularly of energy infrastructure. Now, we have seen 2 important announcements, both from Aramco, which reported its quarterly earnings about a week and a half ago, and announcements from ADNOC. both of these national energy companies have committed about $50 to $55 billion in capex, and part of that is the construction of more alternative diversions. A new pipeline in the UAE, which Sultan Al Jaber announced yesterday, is already 50% complete. This is ADCOP 2, and it's a Chinese EPC which is doing the construction. That's fantastic news. It's going to be needed, and now that the UAE is not part of OPEC, they are less constrained in terms of their ability to produce. But these things are very expensive, and they take time, and they still are vulnerable to a persistent threat, whether it's drone or missile attacks from Iran, if this does not move into a real settlement, which I think is everyone's basic expectation. The question on, the non-oil economy, particularly in tourism, and Kristian talked a lot about like the sporting events and all kinds of conferencing, which is essentially a big industry in the Gulf. Those plans have been canceled. I mean, our own conference with the Gulf International
Mm-hmm.
Forum in Doha was canceled or postponed in April. And we see this in PMI data very, very clearly. It's basically negative or below 50 across the region. We see Saudi Arabia just kind of bouncing back up into 50 or above territory. The UAE has stayed above 50 this whole period since the end of February, so that's a good sign. But data on Salik traffic, the toll road through Dubai, is way down. Data on hotel occupancy rates in Dubai is about 30% when it was more than 70 or 80% before this crisis. So those numbers are pretty dismal in terms of a return to normal. I would say on the AI and more on the tech investment and outward investment, this really is going to depend. What you're seeing is just a slowdown in decision making across sovereign entities and funds in the Gulf is very hierarchical. These are people who have other responsibilities and security responsibilities. They're going to be pretty busy. So the IPO market, I think, is definitely slowing down. The other thing you'll see is that, yes, there are commitments to big projects like Stargate in the UAE was only going to be about 200 megawatts by next year. So it's still like got a lot of runway. You don't really have to demonstrate completion anytime soon. I think you probably will see less of a commitment in Saudi Arabia because there's so many other spending commitments right now. And we saw in Q1 data, which Saudi Arabia is the only Gulf state that really reports on their budget on a quarterly basis, a real increase in terms of government spending of subsidies. So the money is needed elsewhere, right? So you're going to see that kind of fiscal decision-making tension points for security, for hardening of energy infrastructure, for capex into energy, whether it's gas or oil, and also kind of a slowdown in terms of allocation and decision-making.
Thanks, Karen. Sorry, there was a muting challenge. Yeah, and I think on that note, I think we see a number of Gulf countries needing to put more into liquidity, right? Liquidity support. Maybe that's been some of the biggest impact. But even it seems to me in the UAE, banking data sort of showing that
a lot
time.
of borrowing happening, and most of it through private markets, which is very interesting as well.
Yeah, exactly. We can come, I think, come back to that. Kristian, turning to you and maybe shifting gears a little bit, how are you seeing this crisis affect GCC security relationships and coordination? It seems to me we have some different groups, and it's a bit hard to fully interpret. How are you thinking? What are you seeing in this space? Is this crisis big enough to change some of this calculus? Are there structural issues? Are people overplaying some of the divides between some of the countries in the region? How are you thinking about Gulf security and structures?
Well, I think in any crisis of this magnitude, you could argue that crisis creates space for actions that would not have necessarily been likely beforehand. And we've seen this with other crises, COVID, for example, and kind of military actions in the past. Obviously, we had in the months before February 28, we saw significant Saudi UAE tensions, especially over Yemen back in December, January. We saw almost an unprecedented Saudi airstrike on a shipment of allegedly sort of UAE-bound weapons in southern Yemen. So this backdrop was there. We obviously saw the UAE abruptly leave OPEC in end of April. I mean, not a decision that took everyone by surprise necessarily, but the fact that it was announced the same day that the GCC was having a meeting of senior leaders, including heads of state in Saudi Arabia, to talk about the impact of the conflict, really sent I think, a very strong signal, and unlikely to have been seen by the Saudi hosts as a little bit of a snub. So, in terms of security, we haven't. This is probably the first crisis that has affected all 6 Gulf states at the same time, albeit to different degrees. Obviously, Oman has been attacked a lot less than some of the other Gulf states, UAE, of course, Bahrain, and also Kuwait. And Kuwait and Saudi Arabia also were targeted very heavily from Iraq, from groups operating in Iraq as well. It's not just from Iran. So there were different threat perceptions, different rates of attack and of intensity. In Qatar, the attack on Ras Laffan really did an incredible amount of economic damage. So we haven't really seen I think they'll struggle to define a one-size-fits-all security response. And I think we've seen, certainly with the UAE and Israel and the reports of Israeli systems being deployed to the UAE to assist in missile and drone interception, how that is really deepening what was already an existing defense and security relationship, which does, again, separate the UAE from some of the other Gulf states. And so I think that's likely to be a long-term relationship that will only deepen and grow going forward, and is probably likely to increase the divergence, at least in that respect, between the UAE, for example, and Saudi Arabia. And of course, a lot of people have been talking for years now about the possibility of Saudi Arabia normalizing with Israel, although normalization may not be necessary, in the sense that there's already likely strong levels of collaboration through CENTCOM, which, of course, Israel has been a part of since 2021, albeit that in September last year, the Israelis undertook a missile strike in Doha, which was really, I think, a shock to the system of bringing Israel into CENTCOM, whereas that was meant to increase interoperability, which of course has happened, but it also then had the remarkable sight of one CENTCOM member attacking another within miles of the CENTCOM forward headquarters. And so I think that legacy will take a long time to fully overcome in some of the smaller Gulf states and in Saudi Arabia as well. But the UAE, I think, is definitely powering ahead with making its own arrangements. Now, at the time of the UAE's departure from OPEC, there was speculation, would there be other organizations that the UAE would also decide no longer served its purpose for the 2020s and the second quarter of the 21st century. So far, we haven't necessarily seen anything pan out. The nuclear option would be the UAE to withdraw from the GCC. I don't think that's necessarily going to happen or is likely. But the GCC, I think, has always found it very difficult to sort of cohere around security and defense, just because those threat perceptions have always differed, and because security and defense issues are seen as sovereign matters by the individual states concerned. And so I think, although this is obviously the most severe conflict felt across the GCC that we've faced at least since 1990, since the Iraqi invasion of Kuwait, we're still going to struggle to see a coherent response. And if individual countries go their own way in terms of reimagining what a sort of deterrence and security and defense relationship post-conflict looks like, that might just increase some of those divergent splits.
Thanks, Kristian. I think that's right. I mean, I guess the other trend to watch that maybe all of you will have thoughts about is, in a way, that this conflict brings to bear even more urgency of thinking about the defense industrial base, right? And there's been plans over many decades to try to produce more of the weapons domestically and to think about those partnerships. They've not necessarily come to sort of a lot, but thinking about that, and in this context that a lot of countries are thinking about that, it feels to me like that's also going to be something to watch. What partners? I'm also struck by comments that Emirati officials have sort of said about, well, we remember who our friends are, right? Remember who came to, support, and some of those include neighbors. And so, as you say, this is, wartime is a time to make decisions that could be, the can was kicked, but also it may be a time where we see how these institutions evolve over time. Turning to you, Gawdat, and before I do, audience, please prepare your questions, enter them in, I think it's the YouTube chat, or whatever is going on the cron, and we'll look forward to taking your questions. But Gawdat, I want to turn back to Gulf sovereign funds and the financial resources that I think all three of you have alluded to, especially Karen just a few moments ago. These are sizable pools of capital, give resilience. Of course, there's divergence within the countries, but the Gulf states, almost all of them really stand in contrast, for example, to Iraq, right, which is also facing very extensive economic challenges and has no financial buffers to draw on. How are you interpreting this financial and asset cushion? Does it give Gulf states or some of them the runway they need to restructure, to adapt in this environment? Does it risk deferring reforms? How are you seeing the ability to deploy and utilize and think about these, these sort of pools of past saving and infrastructure that have been developed?
Thank you. This is a great topic, great question, and sovereign wealth funds will play a major role in post-conflict environment. But before I talk about sovereign wealth funds, I want to pick up on Kristian's point about security and the economy, because the outcome of the war, whatever agreement to end the war, will have huge impact on the economy and sovereign wealth funds. We've been for about 4 weeks now in what might be described as no war, no peace between United States and Iran. This will be a nightmare for Gulf economies. The same thing if the outcome of the war becomes like mowing the grass, the Israeli policy in Gaza before October 23, meaning that if there will be periodical attacks on Iran, this will be a disaster for Gulf economies and the economies of the entire Middle East. The whole region wants real peace, end for the tension between United States and Iran, because if there is no real end, it means they cannot invest in economic recovery. It means they will expect another war in 6 months, in 1 year. The war started in late February, was not the first war between the United States, Israel on one side, and Iran. So what Iran, United States, Gulf states, and the entire Middle East want is a real end to the conflict between the United States and Iran. Nobody knows if this will happen. Talking about sovereign wealth funds, they were created for rainy day, and this is very much the rainy day they were created for. So they will play a major role, and not all sovereign wealth funds are the same. The Saudi sovereign wealth fund is more focused on domestic market. It is less exposed to the global economy, unlike, for example, the Emirati sovereign wealth fund. For Saudi Arabia and other Gulf states will focus on domestic economies, will focus on security. I expect huge arms deals with United States, with China, with Europe, Gulf countries will diversify their security relationship. Something sad for poor countries in the region, poor Arab countries like Egypt, like Jordan. There will be less money from Gulf states, basically because they will focus on their security concerns, their building their economies. Something also negative about Gulf economies. For many years, they have made great progress in diversifying their economies. As Karen and Kristian mentioned, tourism, AI, renewable energy, Gulf region from Qatar to UAE to Saudi Arabia have been seen as major tax breaks for people from all over the world. The reputation has impacted. It will take long time to rebuild this reputation.
Thank you very much. We're getting some good questions in from the audience, but there's still time for you all to pose your questions. I wanted to turn to you next, Karen, and pose a question that is partly what I was just asking Gawdat, but also one we've received from the audience, which is thinking about, taking us a little bit into the Gulf investment in the region, in the MENA region, both on this question of energy infrastructure that we've been talking about, but also financial support and the like. How are you expecting that to evolve? And do you have any thoughts, complementary or otherwise, on on how the sovereign and on how this sovereign ecosystem is support for different Gulf countries?
Thanks, Rachel. So yeah, as Gawdat said, I mean, the idea of sovereign wealth funds as a buffer for a moment of crisis is certainly true, but they are really different in terms of their size and their orientation and commitments, particularly to domestic investment, with the PIF being even more focused now with their new strategy on domestic allocations. Moody's did a really interesting study, which I've been citing a lot because I just think it's fabulous. If you look at the kind of 2026 budget planned spending of the 6 GCC states, their debt obligations, and if they were having no hydrocarbon revenues, how long could they continue those outlays, given their government financial assets, whether that's central bank reserves or sovereign wealth funds? And in the case of Abu Dhabi, that timeline is about 20 years. So that's a really long runway in terms of the ability to feel like you are safe. It doesn't mean you're drawing down all those assets. It just means that it's a cushion, it's a buffer. For a country like Bahrain, it's 4 months. You have no cushion. And Kuwait and Qatar, it's about a decade, about 8 to 10 years, and about half that or less for Saudi Arabia. So really different calculations in terms of how long can this persist? What is your current revenue stream from hydrocarbons? How dependent are you? Kuwait GDP is about 45% based on oil revenue, so that's going to be a problem because there's nothing going out. This is just going to be extremely difficult, and there's no interest in drawing them down and having nothing else. So what do allocations look like going forward? We talked a little bit about what are strategic priorities. Certainly defense, military spending will increase. The UAE has even announced a new fund focused on defense capacity. This will be, in various partnerships. So you're not going to see just a relationship with the U.S., though there have been major purchases announced from the United States, about $8.5 billion. But with Ukraine, with Australia, with France, all kinds of partners, including China, on defense material. That will continue. On logistics, Saudi Arabia's Red Sea hubs are looking really great right now. And investments into rail, into trucking routes, even new ports, are all moving forward. In terms of the regional allocations, we had seen basically a diminishing trend line since about 2018 in those massive outlays. My book on Gulf economic statecraft, I track those. commitments of foreign direct investment, central bank deposits, oil and gas in kind transfers. And that era is really over. There's a preference now on, of course, value for money and on hard assets, physical assets. So like the Ras Al Hekma deal, the UAE buying land in Egypt. You're not going to see another $35 billion deal like that, but you will see an interest in stability in the region in exchange for a hard asset, not a blank check. And the need for capital, and we talked a little bit about or hinted about the borrowing needs of the GCC states right now. I think will make it less likely that they're willing to to create particularly central bank deposits and these extensions of large loans within the neighborhood. They're going to be focused on their own needs and thinking about how they diversify their, especially in the energy sector, their assets. So being in the gas business in the United States, building storage and refinery capacity where customers are. So that means building them in South Korea, building them across Asia, building them in wherever you can really secure that product and the demand for it going forward. So I would be really positive on anything that's energy infrastructure in third countries, including in the technology space. So we're going to see, I think, data centers with renewable energy power built in the surrounding areas in sub-Saharan Africa, in Central Asia, maybe before we see more build out inside of the Gulf.
Thanks, Karen. I think really interesting point and ties into a question that we were getting from the audience about investment in renewable energy in the region and beyond. Kristian, I wanted to turn to you, and with all these audience questions, many of you can weigh in on. But the question is whether we're likely to witness a new Gulf economic and maybe we could say security order focused around resilience against aggression instead of efficiency and diversification. I mean, we might question whether it's an either or, but just any thoughts you have about whether there'll be even more of a focus on building redundancies and thinking along those lines. Also, in the same question that I posed to Karen of how are you expecting Gulf involvement with other countries in the MENA region to evolve? Any thoughts on any of those many questions I just threw your way?
No, I think that's absolutely right. Resilience, building redundancies will be the focus because what, if nothing else, the last 2.5, almost 3 months has shown is that the kind of reliance on sort of innocent, safe passage into and out of the Strait of Hormuz is now a risk. I think it had long been talked about as a potential risk that the strait could be closed, and very much people were talking about physical closure as in being mined or physically blocked by the Iranian naval assets. But I think what shocked a lot of people is how easily it was blocked in terms of just raising the risk to insurance companies and to shipping companies who were not prepared to sail through. Obviously, they were coming under attack. Obviously, that's easier said than done in terms of resilience and redundancy. Qatar, for example, has the problem that its main production is of liquefied natural gas, which doesn't really have any outlet other than sailing through the Strait of Hormuz. There will doubtless be ways to think about how they can potentially try to get around that issue. Obviously, they've invested heavily here in Texas with the Golden Pass, which has now started production. We may see an increase in investments, as others have said, outside the Gulf in energy facilities and infrastructure. Of course, these take a long time to come through, but we may see projects being developed that will, over time, make the region less vulnerable to this type of disruption. Kuwait's also being very hard hit, as others have said, in terms of not being able to export any of its oil currently. Obviously, if there were to be investment in pipelines connecting Kuwait and then also southern Iraq to the existing pipeline infrastructure in northern Iraq, which connects to the Mediterranean, that again is a longer term issue, but that would also unblock Iraq's problem right now, which is also similar, that they currently have no real way of getting the oil from southern Iraq to market. We could see the pipelines that were built through Syria back in the 20th century being repurposed or sort of at least renovated. So I think there certainly will be infrastructure investments in Syria, in Jordan. We've seen the UAE and Jordan do a railway tie-up over the last few months, which will try at least to give greater outlets to certain certain commodities on the Mediterranean, on the Red Sea coast. I mean, it's been remarkable how shipping companies have reassessed the risks of sailing through the Bab el-Mandab, even post February 28th, because even though the Houthi attacks on the Bab el-Mandab on shipping really ceased in August, September last year, the shipping companies were still reluctant to fully return to that corridor up until February. But of course, we've seen now how that is really a lifeline. So I think building out those pipeline alternatives, investing in rail for, again, some of the commodities other than oil and gas, which have been hit. Of course, the proviso being that a container ship or a tanker can transport so much more at scale than road and rail equivalents, so they're only perhaps short term. Building out the infrastructure on Oman's coastline as well. Oman has obviously benefited in a sense from being kind of having the access it does to the open sea. So Syria as well. I think Syria is a really interesting example, just because we have the wider backstory there of the post-2024 transition of the US and others trying to accelerate investment into the reconstruction of Syria, Gulf states leading the way, the Saudis, the Qataris, and now also the Emiratis, and Syria, of course, benefiting from its location. So we could see an increase in investments in Syria and in Jordan, and potentially through Iraq. But Iraq, of course, has a problem that you have the militia groups operating in Iraq and the continuing Iranian influence, which has been documented to be a security problem over the last 2.5 months.
I think you're right, and with not that sanctions are always the deterrent that the U.S. government thinks there are. We've definitely seen a renewed focus on Iraqi, sort of domicile targets that are linked to Iran. Also, maybe a different comfort level from GCC states of targeting militias in Iraq. Lots of different factors there. Got it. We're all. I wanted to turn to you to pick up on something you said earlier, which ties in nicely to a question we've received, which is this dynamic of the sort of security, the maritime order in the Strait, not going back to what it was, something I very much agree with. But what are your thoughts on how, if the Strait is not seen as fully reliable, and I think we all agree that it won't be anytime soon, how do you think this is going to reshape economic geography? Before we started this call, we were all chatting a little bit about Syria and projects there. What are your thoughts about whether some of those projects will get up and running? There's been a lot of Gulf interest and pledges in Syria. What is your assessment about how some of these projects will come into fore? And other shifts you could see happening?
I want to end on optimistic note, and I believe there are many good opportunities. First, most likely, if there will be agreement between United States, between Trump administration and Iran to end the war, there will be lifting of economic sanctions on Iran, and at that point, GCC-Iran relations will be very different. Despite the war, despite Iran's attacks on Gulf states, if there will be peace, geography determines the relationship between GCC and Iran. Iran is not going anywhere. Iran, nation of 90 million people, and if US sanctions, UN sanctions will be lifted, Gulf states will be interested in engaging Iran. This is what they did before the war, and I believe this is the only way to make sure that Iran will not attack them again. So I expect if there is agreement between Trump administration and Iran, sanctions will be lifted and GCC states will engage Iran economically. meaning a Gulf investment in Iran with the goal of trying to reduce threats from Iran. Part of this good news for the Red Sea, Yemen, Red Sea will be very important to export oil and gas to bypass the Gulf. So there will be less tension in Yemen. Saudi Arabia will be very interested in some kind of permanent agreement with Al-Houthi. Syria, Lebanon, and Egypt will play a major role in diversifying oil and gas shipments from the Gulf by passing Strait of Hormuz. So Turkey is another country will benefit from peace and diversifying oil and gas shipments bypassing the Gulf. So there are some good news for many countries in the region.
Thank you very much, and a great way to end. In our last couple of minutes, I wanted to give a moment or so to each of you to sort of wrap up. Karen, any thoughts on, well, anything you want to leave us with as a parting thought, or on this question of Iran GCC relations? Which
Yeah, I'm sorry, Gawdat.
seems like a tough one.
I have to
a
disagree
tough one
with
to
you.
navigate.
Yeah, I don't see appeasement as necessarily creating more avenues for economic integration or growth at all. I think most of the redundancies and hardening of energy infrastructure are inflationary. This basically cuts into the profit margin of low cost production energy in the Gulf, and there's no point building oil pipelines that go towards the Mediterranean. That's not where the demand is. That doesn't make any sense to me. So no, I think appeasement essentially is not going to be the answer until we see a change of government and approach from Iran, and then only then can the neighborhood flourish.
Thanks, Karen. Kristian, any parting thoughts on this topic or others?
Well, I think obviously Gulf-Iran relations will be very difficult to rebuild after what has happened, especially the fact that the US and Israel attacked Iran. Iran chose to respond against the Gulf states. That'll take a long time to forget, if ever. So that's going to be, and of course, if we now see individual Gulf states having to engage with Iran to secure passage through the Strait of Hormuz, that could also be another split within the GCC that different states have, by definition, got to make their own arrangements if they do, and that will be another thing to watch if they do that.
Great. With that, Gawdat, do you want to respond and have the last word here? I always like it when panels have disagreements as well.
Yeah,
so,
it is.
You've all given us a lot to think about.
It is much more fun, especially I respect very much my colleagues' expertise, but probably two final points. One, there will be more diversification of the energy mix, more investment in renewable, and also it's interesting. Coal is playing a bigger role now because it's every place available. The other point about Iran, Gulf states have different policies, as my colleagues mentioned. Oman has close relationship with Iran. Qatar, sharing the natural gas field, has taken less aggressive stand on Iran. Kuwait and UAE, Bahrain are different. Saudi Arabia, despite Iran's attacks on energy infrastructure in the kingdom, diplomatic ties have not been severed, unlike when Iran attacked Saudi embassy about 10 years ago or so. So Saudi Arabia has, my understanding, has not ruled out trying to build a relationship with Iran. At the end, it's not appeasing, it is they have no option. You don't choose your neighbor. Iran will always be there. They have to find some way to work together.
Thanks to all of you. I think that's a good place to end on. As we sit here still very much in a war posture, there could be cycles of both more competition before figuring out what if anything, the convivencia is. I think this means, fortunately or unfortunately, we will be having more webinars on this topic as we sort of assess. Please join us at the Gulf, International Forum for these discussions. All of our speakers today have been writing extensively about these topics, so please follow those as well. But with that, it leaves me to thank Karen and Kristian and Gawdat for joining us and sharing the insights today, and also to thank the team at the Gulf International Forum, especially Anas and Danya, for giving us all this platform and all of the insights that they continue to deliver. So thank you all, and please be in touch with any questions or comments.